I'm very excited to share the TPN Q2 rental monitor data. John Loos from FMB kindly guest wrote our monitor this quarter. John, tell me, what did you see in the residential rental space?
Well, Michelle, it was, let's call it quite a sizable knock in the second quarter. From 82% of tenants in good standing in the first quarter, that percentage went down to 73.5. So 73.5% of tenants recorded by TPN were up to speed with their rental payments. Now, that's to give you a bit of perspective. In one quarter back in the global financial crisis, that dropped to 71%. So it's not far off that, and that was a pretty bad number. It was understandable, I guess. I think in the rental market, you get a lot of tenants that make their income in various casual jobs, be it the restaurant sector, jobs where you can lose your income fairly easily. And I suspect that it was a sizable portion of those tenants who very quickly lost income during the lockdowns. We know that a large chunk of retail, manufacturing, various sectors of the economy were shut down, and that took its toll. So while it's not as bad as the commercial property sector, where you saw a far more extreme drop in tenants in good standing, it's still a very sizable knock.
And if we were to look at the different segments of the market, John, which are the segments that are suffering the most?
I think it's safe to say it's the lowest segment. If you look down at the 3,000 and below segment, that's where you have probably the highest percentage of tenants in good standing. And then as you go up the value bands, you find a lower percentage, the 7,000 to 12,000 per month segment being the sweet spot. But then you have a little anomaly. You go further up and above 25,000, the affluent tenants. There you also have a very poor performance of tenants. So it's not quite just going up the value bands. It's to a certain extent, as you go up the rental value bands, it gets better, or down as you get worse. But just that 25,000 plus the high income segment, you also have a very poor turnout.
And there we had, if I remember correctly, 60% of tenants in good standing in that affluent segment of the market, and only 62.5% in the below 3,000 Rand. So as the market opened up and tenants were able to move, because at one point we had complete shutdown and tenants were stuck in the properties where they were. As the market opened up and tenants were able to move, and there were less tenants with an income and tenants moving to friends and family, we saw some impact in the vacancy rates. What did we see in the vacancy rates?
Yes, quite noticeable. At the end of last year, the vacancy rate as surveyed by TPN was about 7.5%. That's moved up to about 11.3% now in the second quarter. So a very noticeable move within 2 quarters. Not surprising. I think you've skirted around some of those, you've mentioned some of those key issues. What typically can happen is new household formation slows down in an economic shock. People lose income, young working people, they can move back to their parents' home. Or they can merge their households in the sense that they might have had 2 rental properties. They go into a property with a friend and ditch the other one. Or even elderly people can move back in with their children in that regard. So you can get more generations in one household, and the overall growth in the number of households in the country can actually slow quite dramatically during recession. Population growth carries on, and a lot of people have talked about population growth that drives residential demand. Well, over the long term, yes, and population growth is fairly stable. You can predict it fairly well, but the number of household growth, number of households growing, that can vary quite dramatically over the economic cycle and can slow down quite dramatically now.
And so as a result of that, we're seeing higher vacancies. I think it's sitting at 11.3%, as you said, and in those more challenging segments of the market, so the luxury section of the market at 23%. And at the low end of the market, those rents below 3,000 Rand per month at 17%. So with higher vacancies, that has an impact on escalations.
It does indeed. And if you look at the rental inflation from a few years ago, TPN's numbers in 2015 above 5% year on year. That's down to 1.6% odd now. Similar to Stats SA's picture, their CPI for rentals down to 1.8% growth now and slowing. I think probably we'll get to negatives where we'll actually see an all-out average decline. I think this economic shock was probably severe enough to cause some rental deflation.
Yeah, I think our preliminary data so long for Q3 is showing that in some segments of the market we've got negative escalation. But John, my final question, and what everyone wants to know, is where's the recovery?
Well, if you look at if you take TPN's preliminary data, which goes up to July, you can see some signs of recovery on a monthly basis. Not wonderful yet, not spectacular, but you can see early hints of a slight rise in the percentage. I think we have to be realistic about the time frame. Look, it gets better. Just the fact that the economy opened up again, and a lot of people can, those I talked about who had more sort of flexible and casual jobs and incomes, a lot of them can resume and make some money again where they were totally shut down, the restaurant worker, whatever it may be. So it gets a little bit better from the nasty shock of April and May. But I think that we have to be realistic about timeframes. Full recovery for this economy is could be 2 years away or so. If you look at, because national production can't just resume its previous levels prior to COVID, because a lot of, or a portion of production capacity in this economy is shut down. There are businesses that have already shut their doors, and there's still the lagged impact of those that have been holding on but are financially under severe pressure and will still close their doors, unfortunately. So you've lost a portion of production capability in this economy. So the immediate recovery out of lockdown is swift, but maybe back up to 80 or 90% of GDP before lockdown, which means for a lot of businesses it might be a 70 or 80 or 90% of pre-COVID sales, not 100%. So, and that impacts on the number of people they can keep employed. And so I think there's still the lagged impacts in terms of significant amount of retrenching to be done by corporates and all those ugly things. And that will impact on the rental market. So I think it's better in the rental market now that lockdown's over, but to get back to those 85% tenants in good standing numbers of a couple of years ago, before this economy was slid gradually. So I'm talking around about maybe 2015 or so, some very good rental numbers. To get back to those is probably a few years away. It's very difficult to see it just, we can't just get out of lockdown and expect business as usual, full recovery within months. It's more a matter of years.
So I think the message to landlords then is to plan for a slow recovery in terms of tenants being able to afford their rental, any form of escalations in the short term, and the new normal might be higher vacancies. So creating attractive incentives to get tenants into your rental space.
Yeah, no, for landlords it's going to be significantly more competitive for a while, and if you have a good tenant, look after them.
Hold
I guess.
on to it. Hold on to your good tenants, folks. Thanks, John.
It's a pleasure.